all that stuff has been going on. I do believe that Bitcoin will resume higher here once we get through this period. I have a hedge fund invest in Bitcoin and Bitcoin related companies for very long runway. I'm not looking at this thing as just a trade. So the people listening, do with that what you will, but I have extremely high confidence in Bitcoin over the long term as a debasement asset, meaning something like gold that will protect you against this relentless debasement that we're seeing.
Right now, institutional investors are trapped in a high-stakes paradox. On one hand, you have the absolute necessity of AI exposure. If you aren't in the Magnificent Seven, you aren't just trailing, you're failing your mandates. On the other hand, we are witnessing the insane multiples of a market pushed to its absolute limit. But behind the scenes, something much more significant than a tech rally is happening. A barbell trade has emerged. While one side of the market chases the AI dragon, the other side is quietly loading up on what James Lavish calls the debasement trade. James Lavish points out a stark reality for anyone holding an S&P 500 index fund. A third of your exposure comes from just 7 names. These companies are trading at ridiculous multiples, and while the growth is real, the risk of a correlated market meltdown is higher than ever. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
What is going on with gold in the market? Well, it's almost like you cannot, if you're an investor, you have to have exposure to AI. You absolutely must have exposure to it if you're an institutional investor. And so how do you do that? Well, you get it through the Mag 7. There are all-time highs, are ridiculous, insane multiples, okay? But you have to have it. And if you're exposed to anything, if you're exposed to the S&P, you're exposed, a massive percentage, a third of your exposure is coming from 7 names, So you have to have exposure, yet you understand that there's some pretty big risk here. Okay, so if we have a market meltdown for whatever reason, the likelihood is that everything correlates to one, but also on the flip side of that, really quickly, gold is going to be a safe haven asset. So you're seeing a little bit of a barbell trade going on here. You've got, not only do you have central banks buying gold, but you have investors buying gold, kind of to say, well, I want to be invested over here in this AI trade, but I also need to have some sort of ballast over here that will protect me against massive inflation or some sort of crisis. If we have a geopolitical crisis, which, we're not even talking about Venezuela and Iran, there are some massive changes going on globally right now. So you're seeing wise investors that get ahead of this buy up things like gold and silver in order to make sure that they have something that is going to protect them against what's called the debasement of the dollar. It's called the debasement trade. And I have a piece coming out about that in the next number of weeks with Unchained. So, but why are they doing that? Well, again, you've heard experts like Ray Dalio, and Stanley Druckenmiller talk about this. You need to be owning assets that cannot be debased. And so that brings us to the question of what's going on with Bitcoin then? I thought Bitcoin couldn't be debased, and that is true. But remember, Bitcoin it had a massive run from the just about 60,000 some odd, all the way up over 100,000 to new highs of 130,000 when Trump was elected. And we had this surge in price of Bitcoin on this change of administration. And so it did have a run. Now, whether or not you're in the 4-year cycle, people can debate that. Again, they can debate that till the cows come home. I believe that we don't have a 4-year cycle anymore. I believe that, we are in a liquidity cycle. Where that liquidity goes, you're going to have to watch. It's not just U.S. liquidity, it's global liquidity. And there's kind of there's a fight going on there. You've got liquidity being contracted in places like Europe, but it's expanding in places like China and the US, so it's kind of a battle there. But China and US are a lot bigger than Europe. So I would expect there to be continued liquidity for a little bit here. But I do expect it to kind of peak out in 2026 globally. And there's going to be enough economies that are contracting liquidity. So where does that leave us for Bitcoin? Well, again, Bitcoin's been the leading risk asset. It's been the tip of the risk spear, as I've been saying for years here. The general population doesn't believe that it is a risk-off asset yet. They just don't understand it. So it's going to continue to trade like a risk-on asset until it doesn't. That's number one. Number two, and so these investors have said, "Oh, this thing already ran. I'm going to get out of this, and I'm going to buy gold, and I'm going to buy the Mag 7 and get in front of that now and kind of trade into that." That's part of it. Part of it is that you had OGs selling over 1 million coins last year. It ran over $100,000. The 4-year cycle in what I suspect, I don't know, but I suspect in their mind, they're like, okay, it's run enough. It's over $100,000. I'm going to cash out here. I've been sitting on this thing since 2011, 2012, and I've made hundreds of millions of dollars. I'm going to go fund my lifestyle and, buy other assets, diversify into other hard assets to have generational wealth myself, whether it's land, houses, whatever it may be. That bravo, they've done well. I don't blame them, but that has obviously caused a lot of pressure here. And obviously the movement of out of Bitcoin into Bitcoin treasury companies has been, that's caused this kind of ripple as well. Now, long term, I think those companies there's a handful of them that I think are going to do exceedingly well when Bitcoin does resume its march upward in price. And, companies like obviously MicroStrategy, 21 with Jack, and he's got a very strong access to capital markets, and asset and Strive Asset Management, what I'm on the board of. I can't really say much about that because we're in the middle of a merger here, but I believe that we have a strong, really strong management and strong game plan to take advantage of this of an arbitrage against US dollars with Bitcoin here. But anyway, all that stuff has been going on. I do believe that Bitcoin will resume higher here once we get through this period. But again, John, I'm a long-term investor here. I have a hedge fund invest in Bitcoin and Bitcoin related companies for very long runway. I'm not looking at this thing as just a trade. So the people listening, do with that what you will, but I have extremely high confidence in Bitcoin over the long term as a debasement asset, meaning something like gold that will protect you against this relentless debasement that we're seeing.
Liquidity isn't a monolith. Right now, there is a global tug of war. We see liquidity contracting in Europe, but expanding in China and the US. Since the US and China are the massive engines of the global economy, liquidity has remained net positive. However, Lavish issues a warning. He expects global liquidity to peak in 2026. As more economies begin to contract, the risk on assets like Bitcoin and high multiple tech stocks will face their greatest test. The question isn't whether the music will stop, but who will have a seat or a bar of gold when it does.
Hedge funds and other financial companies, investors will need dollars sometimes, especially at the end of a quarter, month end, and especially at quarter end, in order to have their ratios in a certain amount to meet their risk requirements. Okay, so sometimes they need more dollars than assets on their books, and if they're holding a bunch of treasuries, what they'll do is they will lend those treasuries to another institution to borrow dollars against them. It's typically another bank. Okay, and the rate at which they're charged to do that is called the SOFR rate. Okay. So what happens though sometimes is there's just not enough dollars to go around, and that SOFR rate can spike. And when it spikes, it starts making things a little chaotic. Okay. And so the bond market begins to lock up, and it becomes problematic, where you're not having the regular players out there buying treasuries, and then the treasury market locks up, and that's an issue. So when have we seen this happen before? Well, back in 2019, in September of 2019, before
the
COVID,
crisis.
The repo crisis. Your normal person doesn't know that this ever happened, because all they know is that we came into 2020 and all hell broke loose. But in 2019, when we were doing QT, okay, when the Fed was still doing quantitative tightening from the great financial crisis back in 2008, and they started printing all that money in 2010, 11, and you could see the rise in the bank and in the Fed assets. Well, they were selling those back into the market in 2016, 2017, 2018, 2019, slowly, but they were trying to get those off the books. They were saying this was only temporary, that we bought these and put them on the Fed's books, and we're going to put them back in the market and take that liquidity back out. Yeah, bullshit. What happened was they started selling these, and then you had the bank reserves got too low, and there was a convergence of factors that happened. You had overnight, you had the dollar was trading at a level that the overseas you need more dollars. So you had international firms needed dollars. Then here you had tax payments by corporations that were due, and so they needed dollars. And at the same time that the Treasury came out and said, oh, by the way, we're going to have to issue a little bit more debt in the coming quarter, which surprised some people, like, oh, whoa, wait a minute. So now you had you had your main banks that act as the buyers of these treasuries during these auctions. Okay, the GSIBs, the globally systematic important banks here in America, were buying those, and they needed dollars. You had the corporations needed dollars, and then you had overseas they needed dollars, and you saw the SOFR rate, well, the LIBOR rate spike, the overnight rate spike to like 9% intraday, and it was chaos. So literally within 48 hours, the Fed stopped QT and started QE, meaning they started flooding the market with dollars because they were worried that you're going to have a lockup in the treasury market. They do not. What was the percentage they were trading at, or what were the bank reserves at versus the total bank assets and GDP? They were around 7%. So anytime they start getting below 10%, the Fed starts getting a little bit nervous, and they start injecting liquidity into the market. So now you've got people out there saying, no, this is not, this is not QE. This is just the regular, this is called reserve management, right? And that's what Powell called it. He said, it's just reserve management. That's what we're doing, just to make sure we have enough bank reserves out there. But come on, it's QE. It's just not the QE in technical terms, which is the Fed literally printing dollars and going into the market and buying US treasuries that are longer dated. That's real QE. This is like QE light, pre-QE, but it's like a constant trickle of money that's coming into the market to help shore up those reserves. It is an injection of liquidity. And so if you're talking QE, most people hear QE and they think liquidity injection. It is. It's not technically QE if you're going to use the technical term, but it's
a little different, but it is
addition of liquidity. It's QE light, or whatever you want to call it.
Whatever you want to call it.
The takeaway from James Lavish is clear. Whether you call it reserve management or QE light, the result is the same: the debasement of your currency. If you're an investor, you're forced into a two-front war. You must own the AI future to keep pace with the market, but you must own hard assets like gold and Bitcoin to protect against the inevitable liquidity injections required to keep the banking system from seizing up. Lavish isn't looking at this as a trade. He's looking at it as a multi-decade runway.